Look, let me start with a scene that I know is going to sound painfully familiar. It's Sunday night, you're sitting on the couch, phone in your hand, and you open your investing app just to check. You tell yourself you're not going to do anything. You're just looking, just being responsible, just staying informed. And then you see it. The market's down. Again. Red numbers everywhere. Your portfolio is lower than it was last week, lower than last month, lower than the point where you promised yourself you'd definitely do something. And suddenly, your brain goes into overdrive. Should I sell before this gets worse? Should I move everything to cash? Maybe I should switch funds. Maybe I should wait for things to calm down. Maybe I already messed this up. And now you're stressed, you're second guessing every decision you've ever made, and instead of enjoying your Sunday night, you're running imaginary scenarios about what would happen if the market crashes another 20%. If that made you feel slightly uncomfortable, yeah, same. Here's the thing, most people think smart investing is about doing something, making moves, reacting quickly, optimizing, adjusting. But what if I told you that a huge chunk of long-term financial success comes from doing nothing? And not nothing in a lazy way, nothing in a deliberate, disciplined, almost boring way. My name is Tom, and I spend way too much time thinking about personal finance and investing psychology. If you're someone who constantly feels the urge to tinker with your investments, react to the news, or make changes because it feels irresponsible not to, make sure to hit the subscribe button and give this video a thumbs up if this helps you out, because today I want to talk about why doing nothing is sometimes the smartest financial move you can make, and why almost everything in your brain is wired to fight that idea. Now, look, I already know what some of you are thinking. Doing nothing sounds nice, Tom, but that's how people miss opportunities. That's how people fall behind. That's how you end up being passive while everyone else is making money. Totally fair concern. But let's challenge a really common assumption right out of the gate. The assumption is this: more decisions equals better outcomes. In finance, that's often backwards. In fact, some of the worst financial outcomes in history came from people who were extremely active, highly informed, and constantly making moves. Here's what most people don't realize. The market doesn't reward activity. It rewards endurance. Let me give you a stat that sounds fake, but isn't. A famous study by Fidelity looked at their best performing investment accounts over multiple decades. You know who they found at the top? Not hedge fund managers, not day traders, not people with MBAs. It was people who forgot they had accounts, and people who had passed away. I wish I were kidding. The accounts with the least activity, no panic selling, no emotional switching, no, I'll just make one small change, perform the best. Now, before you think this is just a cute anecdote, let's talk numbers. According to Dalbar, which tracks real investor behavior, the average equity investor underperforms the market by several percentage points per year. Historically, the S&P 500 might return something like 9 to 10% over long periods. The average investor, more like 5-6%. That gap doesn't come from bad funds, it comes from bad timing. Buying after things feel safe, selling after things feel scary, doing something when doing nothing would have been better. This is where it gets really interesting. Let's say you invest $10,000 and earn 10% per year for 30 years. That turns into about $174,000. But if your return drops to 7%, just 3 percentage points, you end up with about $76,000. Same money, same time, radically different outcome. And the reason most people land closer to 7% than 10% isn't fees or bad luck, it's behavior. Look, markets are volatile. That's not a flaw. That's the price of admission. Over the last century, the market has gone up most of the time, but along the way, you get crashes, corrections, recessions, wars, bubbles, pandemics, and headlines screaming that this time is different. And every single time, your brain goes, okay, but this time actually feels different. Here's what most people don't realize. Your brain is not designed to manage long-term investing. It's designed to keep you alive. And those are very different jobs. Your brain is obsessed with short-term threats. Losses feel about twice as painful as gains feel good. That's called loss aversion. So when your portfolio drops 20%, it doesn't feel like temporary volatility. It feels like danger. Your instincts don't say, historically, this is normal. They say, make it stop. So you sell, or you switch, or you wait just until things stabilize. And look, emotionally, that feels responsible. Mathematically, it's often disastrous. Now you might be thinking, okay, Tom, but surely some action is better than none. Surely being engaged beats being passive. Here's the uncomfortable truth. In investing, action is easy. Restraint is hard. Doing something gives you the illusion of control. Doing nothing feels like neglect. But markets don't care how involved you feel. They care about time. Here's an analogy I love. Imagine you plant a tree. Now imagine you dig it up every few months to check how the roots are doing. You're being proactive, right? You're monitoring progress. Except you're killing the tree. Long-term investing works the same way. Constant interference, even when well-intentioned, destroys compounding. Let's talk about compounding for a second, because this is where people nod along but don't feel it. Compounding is not linear. It's slow, boring, almost disappointing at first. The first 10 years of investing don't feel that impressive. The magic happens later, but if you interrupt the process, if you sell during downturns, sit in cash waiting for clarity, or jump in and out, you reset the clock over and over again. And here's the part no one likes to admit. Most of the market's gains happen in a very small number of days. Miss the best 10 days over a 20-year period, and your returns get crushed. Miss the best 20 or 30 days, and it's even worse. And guess what? Those best days usually happen right around the worst days. So when people say, I'll just wait until things calm down, what they're really saying is, I'm okay with missing the recovery. Because by the time things feel safe, prices are already higher. This is why doing nothing is often the smartest move. Not because nothing is happening, but because everything important is happening without your interference. Now let me tell you a quick story. Back in the early 2000s, after the dot-com crash, investors were wrecked. The market had been hyped, then crushed. People were burned. Trust was gone. Then 2008 happened. Financial crisis, banks collapsing, people losing jobs, homes, retirement savings. If you had sold during those periods, it felt logical. It felt responsible. It felt like self-preservation. But if you had done nothing, literally nothing, and just held a broad market portfolio, you would have recovered, and then some. The people who did best weren't the smartest, they were the most patient. This is where psychology quietly dominates math. Because knowing what to do is easy. Actually doing it is brutal. Your brain wants action during uncertainty. Stillness feels wrong, and financial media doesn't help. Turn on the news and it's all urgency. Breaking news, market turmoil, expert opinions, predictions. No one goes on TV and says, honestly, you should probably do nothing for the next 20 years. That doesn't get clicks, but it works. Here's what most people don't realize. Successful investing is mostly about not making mistakes, avoiding panic, avoiding overconfidence, avoiding unnecessary changes. You don't need to be brilliant. You need to be boring. Now, that doesn't mean literally never doing anything. It means separating planning from reacting. A smart investor makes decisions in advance when emotions are calm. They decide what they'll invest in, how often they'll invest, when they'll rebalance, under what conditions they'll change course. And then, this is the hard part, they stick to it. They don't let headlines rewrite the plan. They don't confuse motion with progress. They understand that the urge to act is often the enemy. In the next part, I want to go deeper into when doing nothing is smart and when it absolutely is not. We're going to talk about the difference between discipline and negligence, when doing nothing becomes an excuse, why boredom is a competitive advantage, and the exact rules you can use to know when to act and when to stay put. Because this isn't about passivity, it's about choosing inaction strategically, even when every instinct is screaming at you to do something. And that's where things get really interesting. Now, before anyone twists this into, cool, I guess I'll just ignore my finances forever, let's slow down for a second, because there's a massive difference between disciplined inaction and financial neglect. Doing nothing is only smart when it's intentional, when it's part of a plan, when it's the result of thinking ahead, not avoiding responsibility. Here's what most people don't realize. The biggest financial mistakes usually don't come from ignorance. They come from overreaction. People don't blow up their finances because they never learned how compound interest works. They blow it up because they knew what to do and then didn't follow through when it got uncomfortable. So let's talk about when doing nothing makes sense and when it absolutely does not, because there are moments when action is required. The mistake is acting emotionally instead of structurally. Here's a simple rule that will save you a lot of stress. If the reason you want to act is emotional, you probably shouldn't. If the reason you want to act is structural, planned, and boring, you probably should. Market down 25% and you're panicking? Emotional. You're rebalancing because your asset allocation drifted outside your rules? Structural. Big difference. Now you might be thinking, okay, Tom, but how do I actually know which is which in the moment? Great question. Because in the moment, everything feels urgent. This is where pre-commitment becomes your secret weapon. Smart investors decide in advance what future Tom is allowed to do and what he's not allowed to touch, because future Tom under stress is not that smart. Look, you might trust yourself right now, calm, logical, watching this video, but the version of you checking your portfolio during a crash, that guy is a mess, so we don't give him control. Here's what disciplined investors do instead. They set rules like, I invest every month no matter what. I rebalance once per year, not whenever I feel like it. I don't sell based on headlines. I only change my strategy if my life circumstances change, not the market. Notice something? None of that depends on predictions. There's no if I think the market is going to, because that's the trap. Here's what most people don't realize. Predicting the future is not required to build wealth. In fact, it's often the thing that ruins it. The market already prices in everyone's predictions, fears, hopes, and guesses. By the time you feel confident about a move, it's usually too late, which brings us to boredom. Boredom is one of the most underrated advantages in investing. The best strategy often feels underwhelming. It doesn't give you stories to tell at dinner parties. It doesn't make you feel clever. It doesn't give you dopamine hits. It just quietly works. And humans hate that. We are wired to seek stimulation. Action feels productive. Stillness feels like failure. That's why people check their portfolios constantly. That's why they tweak allocations that don't need tweaking. That's why they chase whatever worked last year. Not because it's smart, but because it's interesting. And interesting is dangerous. Here's an analogy that makes this painfully clear. Imagine you're on a long flight. You don't stand up every 10 minutes to optimize your seat position. You don't ask the pilot to reroute because you hit turbulence. You don't jump out halfway because the ride got uncomfortable. You sit there, you wait, you trust the process. Investing is the same. Turbulence is normal. It doesn't mean something is broken. Now let's address a big objection head on. Tom, doing nothing sounds great if you already have money, but what if you're just starting out? This is where it gets really interesting. Doing nothing is actually harder when you're new, because the stakes feel higher emotionally, even if they're lower mathematically. When your account balance is small, every dollar feels important, every dip feels personal. But mathematically, the early years are when mistakes matter least. Your biggest asset early on isn't your portfolio, it's your future contributions. That means the most important thing you can do is not sabotage consistency, which brings us to one of the most powerful ideas in personal finance. Most of your success comes from avoiding big errors, not making brilliant moves. You don't need to buy the perfect stock. You need to avoid panic selling, excessive trading, sitting in cash for years waiting, constant strategy hopping. Those mistakes are devastating, and they usually come from the urge to act. Here's what most people don't realize. The market rewards patience because patience is uncomfortable. If it were easy, everyone would do it, and the reward would disappear. That discomfort is the price you pay for long-term returns, and no one tells you that up front. They sell investing as this clean, logical process. Pick good assets, hold them, win. But the real challenge isn't choosing the assets. It's living with uncertainty without flinching. It's watching numbers go down and not intervening. It's trusting math over emotion. That's why doing nothing feels wrong, even when it's right. Now, let's make this practical. Here are a few actionable rules you can apply immediately. Rule number 1, separate decisions from execution. Decisions happen rarely, calmly, and intentionally. Execution happens automatically. If you're making frequent decisions, something is wrong. Rule number 2, reduce the number of things you can mess up. Automation is not laziness. It's protection, automatic investing, automatic rebalancing. Fewer buttons to push. The less often you have to rely on willpower, the better. Rule number 3, if you feel the urge to act, pause. Not forever, just 48 hours. If it still makes sense after the emotional spike passes, fine, but most of the time, the urge fades. Rule number 4, remember that feeling smart is not the goal. Building wealth is not about being right all the time. It's about staying in the game. Look, I know this sounds almost too simple. Just don't do dumb stuff. But simple doesn't mean easy. Doing nothing requires humility. It requires admitting you don't control the market. It requires patience in a world obsessed with action. And honestly, that's why so few people do it well. They confuse activity with intelligence. They confuse motion with progress. They confuse anxiety with insight. But the people who win long term, they embrace boredom. They let compounding do the heavy lifting. They understand that sometimes the smartest move isn't making a move at all. So if you take one thing away from this video, let it be this. You don't need to outsmart the market. You need to stop sabotaging yourself. Make a plan. Commit to it. And when the noise gets loud, when fear spikes, when headlines scream, when your brain demands action, remember that doing nothing can be a powerful choice. Not because nothing is happening, but because the most important thing is already in motion. If this helped you think differently about money, hit the like button, subscribe if you haven't already, and let me know in the comments. What's the hardest part for you about doing nothing? Because for most people, that's the real work.